All right, guys, welcome back. And we're going to be doing chapter 17 now. This is going to be your real estate investments and business opportunity brokerage. Okay? So now this chapter is going to be a very short and brief chapter. We only are going to have one question on the state exam from this chapter. So there's going to be a couple of items that we're going to have to take care of, but it was not going to be too involved. And again, there's only going to be one question. So let's just go through what you're going to need to make sure that you know what you need for the exam. And then we'll go ahead and finish up. Should be a fairly quick chapter and painless. Okay? So first things first, we're going to need to know and understand our terminologies. Okay? There's going to be a bunch of terminology that we're going to need to know. First one is going to be appreciation. What is appreciation? It is when a property it increases in value over time. Usually investment properties, rental properties, just real estate as a whole tends to have a appreciative feature to it, which is why it's so attractive, yet it creates a lot of millionaires because when people purchase properties and the value goes up, now you can take that equity, invest, and do many different things with it. Okay? Assets. So assets in its very basic form is going to be anything that puts money in your pocket, something that essentially is making you more money or putting money in your pocket, like I said. Okay? Now we have cash flow. Cash flow is anything left over after your revenue from your rentals per se come in, and after you pay your expenses, whatever you're making a month or you're putting into your pocket, that's going to be your cash flow. Okay? Then you're going to have equity. Equity is exactly whatever the property's worth minus what you owe is going to be your equity, or essentially the percentage of the property that you technically own. Now, you may have purchased the property at a certain point, but equity is always figured out on current market value. So if you bought a property last year for $200,000 and this year is worth $250,000, and let's say you got it with a $50,000 down, so you owe $150,000, well, you're going to have $100,000 in equity because the property appreciated $50,000 this year. Obviously, you're going to owe a little less because you've been paying for a year, but first year, as some of you guys might already know, especially from the mortgage chapter, you're going to know you're not paying much on the principal in the first 5-10 years of the loan. You're going to have to put more money on top to start decreasing that principal balance. Okay? Next, we're going to have leverage. So leverage is something that investors, and if you're an investor or would like to invest, it's something that you're definitely going to have to take into account and put to practice if you're looking to make a lot of money and not use your own money. Because leverage means using other people's money to make money. So banks' money, private money, hard money, whatever the case may be. Next, we have liquidity. So liquidity essentially is how quickly you can now take your asset or whatever you own and get rid of it so you have cash money or can quickly, transact. Because real estate, as we either looked or we're going to be looking at, is an industry that is illiquid in the sense that it takes a while to sell a property, anywhere from 30 to 45 days. Sometimes a little quicker, but it's hard to be liquid when you're dealing with real estate. Usually liquid is going to be stuff you have in the bank, things you can cash in quickly and go ahead and pay things and move forward. Okay? Then you're going to have what is known as your basis. Your basis is essentially what you acquired the property for, because there's a thing called your adjusted basis. So your adjusted basis is including expenses, repairs, so you get the full amount of how much a property actually costs you. Well, your basis is just how much you acquired it for. Okay? Then you're going to have what is known as a capital gain or a capital loss. Now, real estate is deemed a capital asset. Now, a capital gain or a capital loss is any earnings you've had on the property after you sold it. Okay? And the same goes with the loss. How much you lost after you sold it. Now, anytime that we sell for profit, let's say you bought a property for $200,000 and you end up selling it for 300, after expenses and things like that, whatever your profit becomes, now you're going to have to pay what they call a capital gains tax. Now, the longer you've held the property, the less of the tax that you pay, what they call long-term capital gains tax. Versus if you hold it for a short period of time, like a flip, you're going to end up paying what they call a short-term capital gains tax, which is at a higher tax bracket. Now, if you're an investor and you tend to be on the savvier side, it might be worth discussing with your accountant or your real estate professional what options you have so you can defer those taxes. You want to shelter those taxes, which brings us to the next term, which is tax shelter, meaning those are ways that you can now defer those taxes and can save the money that you would pay the government for taxes in your pocket. Now, there's things like 1031 exchanges, like if you're transacting through a business, you can now, let's say, use the capital gains or your earnings to reinvest quickly. So now by the time that you go ahead and file for taxes, that money is gone. But usually you have to transact under a business structure for something like that. Now, there's many different ways. Again, for tax sheltering, I would always advise talking to your attorney, your tax professional, your potential realtor or agent, so that way they can start guiding you and you can start doing your research from there. Okay? Then we also have what is known as a real estate investment trust, or a REIT. A real estate investment trust is essentially a form of investing. You can go ahead, for people, anybody, they can go online. There's different trusts that you can invest in. And essentially, if you only have $1,000, well, you can invest your money, earn an interest on your money. So you can technically, without necessarily buying properties, you can start moving your money and you can start, acquiring more properties and things like that. Not necessarily acquiring properties, but earning money on your money at a higher interest rate than you probably would at a savings account or a CD or something like that. You just have to do your research, but that is an option for potential investors and people that want to go ahead and invest. Next, we're going to be looking at risk. Risk is something that is extremely important to understand whenever you're doing business, whenever you're doing practically anything in life, because that is one area that, regardless of what we do, there's always some risk or another. In economics, we call it opportunity cost, meaning the risk of missing out on something else for doing something different. It is important that you understand what risks you're encountering whenever you're tackling or getting into real estate, so that way, whenever our goal is to always to minimize or mitigate the risk and take educated decisions. Because no matter what in this life, especially in business, risk is always going to be involved. Okay? Now, we're going to look at the types of real estate investments. First, we have residential investment. Okay, that's going to be your residential properties. That is going to be essentially, and we stated, what is the definition of a residential transaction? It is going to be improved land, 4 units dwellings or less, unimproved land or vacant land zoned for 1 to 4 unit dwellings, and agricultural land, 10 acres or less. Okay, then we're going to have our commercial investments. That is going to be now, let's say, multifamily, public establishments, buildings, things along those lines. Then we're also going to have industrial. That is going to be more your power plants, effluents, things that will essentially fall under manufacturing and big scale things. Now, you can always do a little bit more research if you want, because I'm just giving you the broad, basic definitions. Then you have agricultural, which is more of a multi-use. You can farm, you can do, and they tend to be somewhat flexible. Okay? Next, you have business opportunities. Now, when we're dealing with business opportunities, we're specifically dealing with businesses in itself. Now, imagine enterprises, imagine like big companies that have many different things, because now when you're dealing with businesses, you're not just dealing with the property. There could be, marketing department, HR department, R&D, research and development, many different aspects. Along with some businesses have what they call goodwill. I don't know if you're familiar with the term, but goodwill is essentially an intangible asset or an intangible item that a business can have by having great reputation, a lot of following, and customer loyalty. Because a company that, let's say, has a lot of following and a lot of people, for example, let's say Apple is going to be worth more than just the company in itself, just because of its goodwill or the loyalty people have to the brand. So that's an intangible that some companies have that have been successful and have been in the industry for a while, and at the same time are things that we as agents, we need to incorporate if we ever dabble into the business opportunities and selling business opportunities and things like that. Okay? Now, next we're going to be looking at the advantages and disadvantages of real estate investing. Okay? So first things first, we're going to look at the assessment of risks. Okay? We're going to have business risk, which deals with the business in itself and the potential of the business doing well or not doing well. We're going to have financial risk that would deal with the actual money. You know, how risky is it for us to default? How risky is it going to be to essentially, make sure that we don't lose or lose our money per se. Easiest way to look at it. Next, you're going to look at purchasing power risk, meaning how powerful is my money to be able to buy things or not buy things. Obviously, inflation would be something that would influence our purchasing power risk. Same thing with interest rates. Because, for example, if let's say things go up in price, then our purchasing power risk will go down because we cannot purchase with the money that we have as much as we normally would have as prices go up. Okay? And then we're going to have interest rate risk, meaning the higher the interest rate, the less we can actually acquire, because now, what is interest rate? It is the cost to borrow funds. And if interest rates go up, guess what? Now you're going to pay more for the same amount of money that you're borrowing. So essentially, it's going to cut into our profits. So make sure you understand the assessment of risk. Okay? Now we're going to be looking at risk that affects returns. Okay? We have liquidity risk, meaning how quickly can I get rid of my property and get my cash out? Like we looked at earlier, liquidity. Because, for example, if you're seeing the market starting to tank and you want to get your money out, sometimes when we're dealing with real estate, that it's a process that does take a while, you're going to end up potentially losing money or have a lot of liquidity risk because it does take a while to sell a property and get your property back out or your money back out. Okay? Then we're going to look at safety risk, okay? Specifically, market risk. Okay, so when we're looking at market risk is the increases and decreases of the market, because if let's say we as investors per se, we are over leveraged or we're buying a lot of property and staying in a lot of debt, if we don't understand the risks of the market could be dictating that it's on the way down and we're acquiring properties at a higher loan amount, which if the market does tank, you will be in a world of problems because now you're going to be upside down, potentially. So that is a balance that investors must kind of evaluate before they start to invest, because sure, for some investors, that is great, but up to what limit? And that's something to definitely consider. Next, we have risk of default. How likely are we to default, in the sense of, do we have enough reserves that in case something happens, the market tanks, we can now have enough time to get rid of the property, take our loss, and still be okay? Or if we do default and we don't have that plan or that backing, then what's going to happen? Now we're going to be in problems. So that's another risk that we want to make sure that we understand. Okay? Now again, guys, keep in mind that we're focusing on what's going to be potentially on the exam. We're not covering the full depth of the book. Now, yes, definitely learn and go through it if you need to, but I'm strictly focusing on what's going to be on the exam. So next, we're going to look at business brokerages and the expertise that is required. Okay? Now, whenever you're dealing, like I mentioned earlier, there's extra things that you're going to have to learn and be efficient with when it comes to business opportunity and businesses in itself. For example, you're going to have some knowledge in corporate financing, okay? Because, again, we're dealing with an entire business, not just a property, okay? You're going to have to know business accounting because, for example, you're going to have to understand how the business functions depending on the amount of layers that you're going to find. For example, you're going to have to understand things like what a balance sheet is, what an income statement is, what a liquidation analysis is, along with many different things dealing with businesses. And lastly, you're going to have to deal with valuation of the business because, yes, we use the three approaches that we looked at before, meaning the sales comparison approach, the cost appreciation approach, and the income approach. But now when we're dealing with businesses, there's extra things that we have to incorporate to find the true value of the business. For example, a liquidation analysis. That tells us how quickly we can get rid of a business because a business that is stagnant, that cannot be moved, is going to lose its value. And it's going to be hard for somebody to pay top dollar because it's going to be hard to move, okay? Next, we're going to get into business accounting. Now, when it comes to business accounting, like I mentioned, we're going to need to know what an income statement or income statement analysis is. Meaning, what is an income statement? So an income statement essentially gives you how well the business is doing from a period of time. So meaning, what does the first quarter look like? You're going to look at the income statement to see how, for that period of time that you're trying to evaluate, what is the health of your business. Next, you're going to have your balance sheet analysis. The balance sheet in particular deals with a specific moment in time, meaning as of today, how is my business doing? It doesn't account for the past or for the future or a specific period. It accounts for the moment in time. And then people have to incorporate that because sure, you can evaluate for a period of time, but what if, let's say, from that point forward, the business started tanking or something happened that now the business is not doing well. You want to evaluate the current status of the business, and that's going to be your balance sheet. Next, you're going to have the cash flow analysis, understanding how the business is bringing income in, how much is left over, and is that a sustainable strategy? Is it something that we're using that is currently a trend, that it is providing cash flow or it is providing earnings, but is it something that's going to be sustainable, something that we can keep long term, something that we're going to have to pivot from? There's a lot of things that kind of come into that. Also, asset depreciation. Asset depreciation is a huge deal when it comes specifically with tax sheltering because all assets depreciate, but the government allows us to use those depreciations as tax deductions and credits. Now, savvy investors utilize things like cost segregation to be able to shelter some of those taxes and things like that. So asset depreciation is an important thing to know because that affects the value of our business and how much we can sell it. And lastly, taxation. And that they kind of go hand in hand in the sense that business taxes are different than your personal taxes. And depending on the layers, it can get very, very complicated, okay? So now, valuation of businesses. Like I mentioned earlier, we need to learn how to evaluate businesses. And we utilize the the comparable market analysis that we looked at in chapter 16 for the appraisals. Same for the cost approach, as well as the income analysis, which is the income approach. And lastly, your liquidation analysis, okay? So now, these are all the things that you're going to be tested on the exam, okay? That is about as much as you're going to need from this chapter. The biggest thing is rewind the tape so you start understanding what's what. At the same time, if you have your book, go back to your book in case you need to double check. But as long as you got a basic gist on these terms, only one question is going to pop up from the exam. So be familiar with these items. Again, you don't want to invest too much time on a chapter like this that only has one question when we have chapters like chapter 11, chapter 5 that have 12 questions. Utilize your time efficiently. If you only have an hour to study, go ahead and devote maybe 45 minutes to 40 to 45 minutes on a big chapter, and then maybe 15, 20 minutes on going over things like what we just went through that are fairly quickly, and you're only going to get one question, but at the same time, you do want to make sure that you review this, because sometimes picking up just that little extra point will take you to the next level, because I've seen a lot of students get that 74, and it's rough to get that 74 when you've been studying so hard and you miss it by a single point. It's kind of heartbreaking. I've seen people cry, you know what I mean, and then you have to start over. So the more that you can review and kind of keep things in mind, the easier it's going to be to pick up those extra points. Now, also, we're gonna have, if you want to look at the video eventually of the the design of the exam, that would also kind of help you in the processes that we take to maximize your points. But it is important to make sure that you go over some of these chapters and review them briefly, so you are familiar with some of these terms in case they do pop up on your exam. Hopefully you can pick up that extra point. All right, guys, well, that's going to conclude chapter 17, and I will see you next time for the next chapter. All right, talk soon. Bye-bye.